All right, good afternoon, everyone. Pardon my scratchy throat. I think I picked up a cold from one of my youngest kids, so I have a lozenge in. So if I sound a little raspy today, apologize for that. Welcome to one of our market updates. Glad to see all of you guys here. If you're new to one of our live streams, one, welcome, but two, I don't have any audio feedback, unfortunately, on this platform, so you can't ask me questions directly via your voice, but you can in the audience chat send me messages during my presentation. I've got a screen up in front of me right here that has the questions on it. And so as I'm presenting today, I've got a lot of slides I want to talk about, economic updates, things going on in the market. I'd love to take your questions. I'm going to plan on giving about a 35, 40-minute presentation out of my slide deck, maybe a little bit shorter. And we'll stop along the way and take questions, and then we'll hang out at the end for Q&A as well. So again, welcome. Glad to have you here and excited to get to share our team's thoughts on some of the important things going on in the market, the LifeWorks performance for our factor strategies, which many of you have in your investment portfolios. And then we're going to talk Iran, oil, other key economic indicators, and wrap up with Q&A. So let me get my slides up on the screen here, and we'll jump right in. If you can for me, just so I know everybody can see it, send me a emoji or a thumbs up or say hello real quick in the chat, just so I can make sure that everybody has the ability to shoot questions my way as I'm going through the presentation. All right. Okay, here's my agenda for today. I always put more into these, and we generally have time to cover. So I'm going to do my best to get through all of this stuff in the time that we have allotted. Let's jump right in. We're going to have quite a few what I call spaghetti charts here to get us kicked off. These are going to be line graphs just showing major market indices and their performance on some relative timelines. Now, don't take away from anything that you're going to hear me say today that I am in any way prognosticating on what I think the outcome is going to be for the markets. We believe that the talking heads, the pundits, the people that make predictions like the S&P 500 is going to end the year at 9,600 or whatever, they have a higher likelihood of being wrong rather than being right. So when we're going through market performance, it's more to have an understanding and a context for what's going on and then see some of the economic drivers behind it and understand how LifeWorks is investing our clients' money and how we're navigating the markets that we're in now. But we're not prognosticating. We're not buying and selling certain things based on what's going on in the market. That's just not how we manage our clients' money. If you want to know more about that, on our YouTube page and in previous market updates, I shared very specific examples of how our investment philosophy was built and the methodology that we run it. I'd encourage you to go watch that if you're unfamiliar with it. All right, so what we're looking at here is we're looking at the year-to-date for the market. And the outperformance this year, the leader by far, is actually small caps. The Russell 2000 is the market index that tracks the smallest companies in the market, not the smallest, but smaller relative to the S&P 500. Followed behind that in terms of year-to-date performance are international and emerging markets. That's what the MSCI indices are. And then the S&P 500. The purple line at the bottom, I don't want us to forget about. I'm going to actually circle back around to this when we get to the planning discussion towards the end of my presentation. But what we're looking at there is that is the iShares aggregate bond ETF. This tracks the most broad index for investment grade fixed income in the United States. Okay, so they call it the aggregate bond index. And I use the iShares ETF as a simple proxy for that index because anybody can buy it. It's relatively inexpensive. It's widely traded. And I think it's an easy one for us to use. Bonds have been negative for the year. We're going to see this theme as we zoom out and step back in timeline. Here is our 1 year. Okay. Small caps outperforming the S&P 500, emerging and international outperforming the S&P 500, and bonds lagging way, way at the bottom. Milan just asked a great question. I'll address it here real quick. How often does LifeWorks revisit our investment strategies? So there's two kind of questions here. I'm going to break them apart. How often does LifeWorks recalibrate and update our factors and the research that goes into our investment strategies? That happens on an annual basis. We do a really deep dive into the factors, but we're updating the factor strategies every month based off of the results. So at the firm-wide level, we're updating our factors once a year based off of a deep dive and research. Our clients' accounts are getting updated as the factors produce different holdings and different portfolios. Now, on a client-specific one, how often do we revisit our individual clients' portfolios? That's a slightly different question. And the answer there is that's also at least once a year. And changes to our clients' investment strategies are driven by the client's financial plan, their cash flow needs, and their taxes, not necessarily by what's going on in the market. So great question, Milan, and good to see you here again. All right, so 1 year, we see a similar kind of trajectory. Now, we get asked a lot, and I've covered this before, so I'll just mention it really quick here in passing. LifeWorks in general has a relatively small allocation to international equities. And the reason for that is the research is pretty clear that the longer you look at the timeline of returns in the financial markets, there's an overwhelming winner, which is generally US large cap equities, the S&P 500. So on the equity side of our investment strategies, we are, I'm not going to say over-indexing or allocating to that, because that's probably not the right way, but we are more focused on allocating to US-based large cap equities because of the historical outperformance relative to emerging markets, international equities, and other markets. So I'm just going to step through these relatively quickly. The slides, for those that you want to know, in the recording will be available early next week for you to go back through and watch or share with friends, family, and coworkers. Now, I mentioned here, keep your eye on the purple line at the bottom of the chart. You'll notice a theme. Essentially, equities have absolutely dominated and outperformed the aggregate bond index. Now, just as a quick aside, all of these returns are gross of fees in terms of the market indexes. When I switch in a second here to talking about LifeWorks investment strategies, we'll be showing those as what's called net of fees, which is essentially applying the maximum fee that we are allowed by the SEC to charge clients, which most of our clients are charged nowhere near that, but the SEC requires us to show that. So these ones here on the market indexes are shown just gross of fees. They're just tracking the index. On a 10-year basis, we have the S&P 500 dramatically outperforming international. Then we see Russell 2000, small caps. We see emerging markets, and we see bonds lagging at the very bottom of this. Now, the reason I keep saying pay attention to the purple line is we also get asked a fair amount by clients and by prospective clients why we don't hold as much in fixed income and why we use other types of investment vehicles. And again, we let our investment strategies be driven by science, math, and research. And when we look at the returns, not in every specific case, but when we look at the returns of fixed income relative to equities, and we are cognizant of the fact that the greatest risk you face, and that I face with my money, that everybody faces, the greatest risk is not market volatility, the up and down in the market. The greatest risk is that everything you're going to need to live on is going to cost you and me more every year for the rest of our lives. Now, what I'm talking about there is essentially inflation. For most people, if they're holding a large allocation of fixed income, which a lot of other firms and a lot of other traditional advisors do for their clients, they've essentially been set up to be holding an asset class that has been significantly lagging, not just the equity markets, but also inflation. All right, so let's just talk a little about the LifeWorks factor models. Again, if you're new to LifeWorks and you're a new client and you haven't watched any of our videos unpacking what factors mean, how our investment methodology and philosophy works, you can go find that on our YouTube channel. We'll put that as a reference in the follow-up email as well, so you can easily find those videos. But simply put, quick primer, a factor is essentially a filter that can be applied to a group of financial investments, stocks, bonds, et cetera. So an example would be we take the S&P 500 And we use factors like price to equity, price to book, profitability. And we rank those companies from number 1 to number 500. Okay. So we're using factors that are scientifically proven, that have Nobel Prize winning research behind them, to filter for the equities in the S&P 500 that have the highest probability of achieving the stated objective, which for our diversified Premia is essentially to track the S&P 500 with only 80% of the volatility. And for opportunity, it's tracking momentum and tech. And for quality, it's tracking value and relatively smaller cap stocks. So we apply these factors. They screen for equities. We do that without human bias. We don't have a room full of smart people. It's replicatable, and it's very efficient from a cost perspective wise. And there's really good research backing the outcomes of that type of investing methodology over time. So when we're looking at it year to date, right, this is by no means me saying that LifeWorks is designing our investment strategies to always outperform the S&P 500, and we never sell or promote that. But this year, our factor models, by and large, have outperformed the S&P 500. Most of you also have gold and different things like that in your portfolios. So a lot of our clients are seeing a fairly significant divergence between the rate of return in their accounts and what's going on in the S&P 500 to their benefit. Jump back and look at a one-year return. What we see is the S&P 500 international outperforming LifeWorks factor models right there alongside it. And then we step back and look at it on a longer term basis, 5 years, and I'll show 10 years. The LifeWorks opportunity factor model really focuses on momentum and technology, growth-oriented stocks. And that one does have a clear difference in return from most of the rest of the indices. And then LifeWorks quality focuses on value investing. And if you track the markets at all, if you're a little bit maybe of an investment nerd or you follow some headlines, you probably know that value investing for the last decade or so has really been kind of out of favor, meaning more investment dollars have gone into technology, the Magnificent Seven. So think Amazon, Apple, Google, et cetera, than have gone into boring stocks that most people don't know the name of, but that are highly profitable, that pay dividends, and that are considered a value relative to the price of the stock. Keep your eyes focused on that purple line at the bottom. We see in all of these scenarios, again, fixed income as the lag here. Now, in a 10-year basis, what we see is the factor strategies at LifeWorks are doing exactly what they're designed to do, which is to provide a rate of return that's similar to or slightly better than the S&P 500 with a little bit less volatility. The investment methodology at LifeWorks, how we think about long-term investing for our clients, whether you're 45, 55, or 75, we take a very long-term outlook to our clients' investing. And because we believe the biggest risk that we face as investors, as consumers, as humans, is actually inflation, not market volatility, we're looking to help our clients make investments and manage their money for 10 plus years into the future, right? So on a long-term basis, the LifeWorks factor models, and again, these are net of the maximum fee that we could charge by law, which we don't charge most clients, or I don't even know if we charge any of that. But these returns are net of fees. So the takeaway here shouldn't be LifeWorks patting ourselves on the back. This is me just sharing with you that the performance of the factor strategies that we run at LifeWorks as the core of our investments for our clients are doing exactly what they're supposed to do. And we're really happy and pleased with the results from it. Okay, let's shift gears. That was a quick recap. If anybody has any questions about any particular asset class, don't throw an individual stock ticker at me. I am not a day trader. Other than a few of the big names, I wouldn't be able to tell you what it is. But if there's an asset class or a question about a particular area of the market you want me to address, feel free to throw it there. But I'm going to shift gears now, and I'm going to start talking about things that I'm a little bit more interested in. Market returns, I think, are the output of a well-designed investment portfolio. Economic data is an input. It's something that we do look at some of these things and make decisions around adjusting factors or adjusting our asset allocation methodology to. So the one that's dominated the news for everybody for the last few months is the Iran war. What I just did here is I mapped where a barrel of oil price started in the beginning of this year and the current, I believe this was as of the end of last week, where a price of a barrel of oil stood. Now, what this gets to is this is going to say, well, what is a factor that might be driving inflation, right? Inflation being the number one enemy that we face as long-term investors and consumers. So clearly has been a pretty significant jump up there in the price of oil. Now, for those of you, I just filled up my F-150 the other day. Some states, like our clients and friends in California, have even higher average per gallon of gas. Some states are lower. I was in Indianapolis last month for my son's soccer tournament. And I was like, man, gas is cheaper in Indiana, mostly because their taxes on gas are lower than we pay in Michigan. But nonetheless, there's been a significant increase in the price of gas. I fly a lot for work. Airline tickets have gone up. Why? Well, the cost of a barrel of airplane fuel is really significantly inflated from where it started the year. So things like trucking, any kind of logistics and transportation for goods, whether it be air, sea, trucks, trains might be a little bit different in this regards, but all the energy prices that go into logistics and transporting goods and services are starting to have an impact on the goods and services that you and I would buy, right? John's got a question about using short-term government 3-month treasuries and T1. Yeah, that's a great question, John. The answer here is we oftentimes do. Right now, for our clients who have their accounts custodied at Altruist, the yield on their cash accounts there is equivalent to the short-term treasuries. So we can just hold cash and get FDIC insurance protection on those funds and not have to hold an ETF or hold the treasuries directly. But there have been times historically where we've just held treasuries or we've held a treasury ETF. So our team closely monitors that, and depending on each client-specific situation and whether they're being custodied at Schwab right now or Altruist, there's differences between those two custodians. I talked about that a couple months ago on one of our live streams. So a lot of our clients, we can just hold short-term cash right now. We have another partner we do this with called Flourish that provides our clients with a really attractive rate on their cash. It's very similar to short-term treasuries, but without any of the bid-ask spread cost differences or having to go and buy the individual ones. But we do, and we have historically at different points in time procured either direct treasuries for our clients or used an ETF. If we look at the short-term rates of return world, they're all pretty converged right now. So in my mind, as long as we're getting somewhere in the high 2s, low 3s on our clients' cash or T1 assets, I feel pretty good about that. Great question, though. Now, when we back to oil here a second. So WTI is West Texas Intermediary Crude. This is basically the primary benchmark for oil in the United States. There's another one called Brent Crude, which is more the international pricing. They're relatively close to each other. So I'm just showing one here. But one of the things that I want you to take from looking at this is right now where we sit in May is a little over $100 a barrel. Could it go higher? Sure. Could it go lower? Absolutely. We'll talk about that in just a second. But even in recent history, we haven't crossed the highest price point that we've had on a per barrel price for oil. Now, does that mean I want to pay $5 a gallon when I'm filling up my F-150? Nope. Does it mean I want to pay a lot more for an airplane ticket? No. So I'm not saying that, well, just because it's not as bad as it's always or it's been historically, that means it's good. I just want to put some context here. You'll always hear me say this in my presentations. The media, both traditional and new, online news sites, online pundits generally get more of a reaction, more eyeballs, more clicks, and more attention with bombastic negative or fear-mongering and scare headlines. So, if you go on, I'm not going to say it out loud, but if you go on a really common financial news website, and this would be one maybe a lot of you might go to check the markets or stock prices, you'll just see like glaring red right now. Everything's, doom and gloom. The market's dropped. Yields are up. Haven't been this high. All of those things are designed actually just to capture our attention, and there's not context to it. So when you see a big bright red box and it's like the market sold off 300 points, you're like, yeah, that's 0.19%. we're still up significantly for the year. It's a rounding error, but it catches people's attention. So I say this as it relates to oil as well, that we have had periods of time in recent history where the spike in the price of a barrel of oil has happened and then it's renormalized and come back down. I think that's going to be what we're going to see here as well. Couple of just headlines. I'm not going to cover all these. They'll be in the deck, but we believe at LifeWorks, and I think most of the commentary that we follow and the economists that we're looking at, is that the shock in oil prices is really a geopolitical one, right? The price of a barrel of oil before the US-Iran war, whatever we're going to call it, war, conflict, et cetera, was significantly lower. Output was climbing. Oil was starting to come in from Venezuela again. We were actually seeing increase on the supply side, which would have driven some of the demand side down. So the Strait of Hormuz being closed or having significant issues for tankers transiting that, right, is causing a geopolitical risk that's driving the price up. Now, this is probably nothing that you're maybe not already aware of, but something that I think is important here is a recent Dallas Fed survey or study that I was looking at end of last week, maybe it was yesterday. Their calculation is that it's a very, very small impact right now, currently, to the US consumer from an inflation standpoint. Okay. So even though gas has doubled for a lot of people, or 1.5x, and the price of a barrel of oil is almost doubled, we haven't seen that fully reflected into the inflation and CPI for consumers yet. Probably has a longer tail to it, but one of the takeaways would be some of the suppliers and manufacturers have been trying to lessen some of that burden. So that was the Dallas Fed. I thought that was actually a positive note to put in there. And then there's people that follow the energy sectors really diligently, from Goldman Sachs and a few other places that I pulled research reports from. And their belief is probably something that I think is reasonable too, which is when the conflict in Iran normalizes, and nobody knows when, but when it does, we're likely to actually see the price of a barrel of oil continue its decline from where we started the beginning of the year at. And I think that's good news. What gets talked about relative to inflation is sticky inflation versus temporary inflation. So we have now baked into some of the US economic, and I would even say the international scene, stickier inflation. We have a very low unemployment rate, which means the cost of labor is going up for manufacturers, for service firms. That's sticky. That's not going to, drop the moment there's a truce deal or some kind of peace deal in the Iran-US war. So oil shock to the consumer price index is likely temporal, not structural, and it's driven by geopolitical risk, not stickiness, some kind of like long-term demographic trend that's going to continue to drive it. So there are so many things that rely on oil: plastics, fertilizers, transportation, right? Energy, electrical generation, et cetera. It touches so many aspects of our economy, right? So no one knows, again, how long the war with Iran is going to be, but just know that the biggest news headline right now, price of oil, the impacts to the economy. This is a temporal geopolitical shock, not a structural or long-term inflationary risk, from our opinion. Okay, so shifting gears here a second, or actually kind of continuing the trend about inflation, the thing that just goes up and up and up and never seems to go down, probably should get added to Benjamin Franklin's "There's two things in life that are certain: death and taxes." I think what we could probably add to that in a fiat monetary system and a fractional banking reserve system that we have is that inflation is likely going to continue to rise. The pace of change might shift a little bit, meaning the speed with which prices increase hopefully stays low, but everything that you need to live on is going to cost you more, and me, every year for the rest of our lives. And that's something that we have baked into our financial planning assumptions and into how we think about investing and how we think about financial planning for you, right? So when you look at over the last 36 years here, We see CPI, which is the consumer price index for all urban consumers. This is the most widely used inflation measure in US economic circles. We see that the annualized growth rate was 2.68%, say just under 3%. What we've felt in the last few years is an increase to the pace at which the price of goods and services has changed. So in the last 5 years, the CPI has actually been growing at about 4.6% a year. Now we see that like pretty rapid run up where we were getting 21, 22 going into 23, and then it's kind of levelized a little bit from there. The pace of change has slowed, but there's been a significant, a cumulative change of 25% in the last 5 years. So just put this in context, $1 that bought goods and services 5 years ago is worth 75 cents today, approximately. This is why we have to be very thoughtful about over allocating money to fixed income and short-term fixed income and interest-bearing accounts. It feels safer, but in the long run, it's likely a loser to inflation. At best, we maybe keep pace with inflation, but right now what we've seen lived out in the last couple of years is a lot of fixed income allocations have underperformed inflation. So for those of you that have what's called inflation protected treasuries in your investment strategies, and a lot of you do, we use an ETF for that called VTIP. It's Treasury Inflation Protected Securities, and it's an ETF that buys them. We're doing that strategically to make sure that those shorter term dollars that you need for your retirement are actually hedged against inflation. So let's look at a few more pieces here. Coinciding with this is the Fed funds rate. So why do I say it coincides with inflation? Well, one of the Fed's mandates is to combat inflation. They have a stated objective of trying to keep inflation around 2%. I don't know that they've actually ever achieved said stated objective, but that's one of their mandates. Or you'll hear about it in the news, or you'll hear a talking head or an economist say, well, the Fed's mandate around inflation. One of the primary tools that they use to try and bring inflation down is to raise the federal funds rate. So when you raise the cost of capital, what it costs businesses essentially to borrow money, what it costs us as consumers to borrow money, the theory is that it slows down spending. It slows down CapEx investment on the business side. It slows down consumer spending because the Fed funds rate is essentially one of the base rates, and then consumer rates and borrowing rates are built on top of that. So we had one of the most rapid rises of the Fed funds rates. I think I said that in the correct tense. One of the most rapid increases to the Fed funds rates in history. In fact, I think it was the fastest rate at which they raised rates. Then we saw it normalize. And now for the last couple of quarters, we've actually seen the Fed funds rate start to come down slightly. Now, this matters because there's an argument out there right now in economic circles about whether the inflation rate we have is sticky and is going to be there long term, or whether it's transitory and temporal and we should keep rates steady and not make any changes. So we have a new Fed chair coming in. There's a lot of politics around that. I think the takeaway is the same people who've been kind of managing the Federal Reserve and the economic impacts for the last 5 years, most of them are still around. And I think they did a reasonably good job if you look at most financial metrics and our economic metrics. So maybe the good news is there's some steady at the wheel that's there. But right now, if I was sitting in the Federal Reserve chair, I'd be looking at things like the oil price shock and things going, okay, this is temporal, not structural. We don't need to rush to make any major changes to the Fed funds rate or any policy changes or something like that. So I'd be shocked if we saw any major policy changes coming down from the Federal Reserve. But raising the Fed funds rates is one of the ways the Federal Reserve tries to slow down growth in the economy. It's called cooling off the economy and help bring the inflationary spending pressures down. Treasury yields and 30-year mortgages, short-term Treasury yields hovering around 4% for 2 years, 10 years at 4.47. What is this? Let's quick primer here. I'm not going to go too deep, but this is worth just mentioning. Why is it that the Treasury is paying a 4% yield on 2 years, right? And the market's accepting that. But then on a 10-year, they're accepting, 4.47 yield. The simple answer here is that the market is signaling that it expects inflation to come back down from where it's currently at now and the pace of inflation to slow down. Otherwise, the only logical thing, if investors and the overall market believe that inflation was going to continue running hot, you'd see a much wider gap between short-term Treasury rates and long-term Treasury rates. So could the market be wrong? Yes, but one of the nice thing about having this kind of market data is when you think about millions and millions and millions and millions and millions and millions of market participants, institutions, individuals, governments, sovereign wealth funds, everybody in between, buying US Treasuries, all of the signal that you get from the different buyers and sellers is likely going to create the actual economic reality that we experience. Meaning it's likely that it's the most accurate data around the most likely outcome. Meaning the market expects inflation to cool back down and to come back to historical averages. They see it as a short-term thing, which is why short-term Treasury yields are paying a yield closer to the 10-year. Now, mortgage rates on the 30-year basis, they're coming down a little bit as well, still in the low sixes. So for those of you that got your first home in the 80s and you're telling your kids like me, or even your grandkids about your first mortgage and you were paying 14, 15, 17%, you still have a perspective on how low a 6% 30-year mortgage rate is, historically speaking. For everybody that's, I think, in my age bracket, I'm 44, been a homeowner now for years. My very first mortgage was in the sevens, but for a long period of time, and we had almost a decade where interest rates were zero bound and people were getting mortgages in the mid twos and low threes. A lot of people right now, because of mortgage interest rate moves, are essentially priced out of the market. So this is a longer term structural thing that is impacting home sales, first-time home buyers, and things like that, mortgage affordability. But on a historical basis, a 6% mortgage is still relatively low. All right, another one, and I mentioned this factors into, all these things work together, but this factors into inflation and the economy as well. We've had very low unemployment. Now, that's a good thing, except if you're a business and you're trying to hire people and you have a low unemployment rate, you need to offer a higher and higher wage to try and steal or to get an employee to leave their employer and move over to you. So we do see real household wages increasing. I'll show that in another slide here. But this is going to then have a circular loop. It's going to increase wages, which is going to increase consumer spending power, which will likely translate into them spending more money, which will likely translate into pushing up the CPI, driving inflation. I'm going to go through these ones really fast. The next one's kind of in succession. Again, if you have questions, feel free to throw them out to me. I'm almost done with my deck, and then I'll take Q&A on other topics. News headlines are always negative. No political harm here. I kind of dislike politicians of all stripes. I don't really trust any of them. But the news headlines, again, are generally derived to be more fear-mongering and negative. It's important to note, and I didn't put the actual numbers here, but blue means positive, and this kind of like orangish color means negative. We've had now for a while real GDP growth, which means inflation-adjusted growth for the US economy. It's been positive. There are structural imbalances. The wealth gap between even middle class and below and the top 10% has been increasing. That's a structural problem. I don't have the answer to it. But in terms of the overall state of the economy, most businesses are at, if not all-time high, very high profit margins. Their balance sheets are solid. The overall economy is doing well, but there are headwinds, price of oil, geopolitical risk, things like that. But I just wanted to put in there that real GDP growth has been positive, and I think that's something worth calling out. Now, I meant to actually stick this slide back before the last one, so apologies for me jumping topics. I talked about real median earnings for households going up slightly. The growth rate for most, the median household wages in the United States is only 0.62% when we annualize it back for 30 years. So on average, what you want to take away from this is that the US consumer has seen their real wages, which means adjusted for inflation, basically flat for 30 years, while the price of their home, while the amount of their credit card debt, while their spending has continued to increase. So this is total consumer credit card debt out there, even in times where there's economic uncertainty, with the exception of like 08, 09, where we saw a little bit of a drop in total consumer credit card debt. The US consumer has basically been continuing to add to their consumer debt each and every year. A data point that's worth kind of tracking, and so we keep our eyes on this one as well, is credit card delinquency rates. There hasn't at least been reported any spike or significant spike in delinquency rates, which can be a sign of significant financial strain on the American consumer. Right now, credit card delinquency rates, based on last reporting, are still relatively flat from where they've been for the last few years. Now back to the Fed. I jumped slides, just put these two in the wrong spot. I wanted to do real GDP next to this one here. Federal surplus or deficit. Orange means that the government is spending more than they take in. That would be a deficit. Blue means there was a surplus. And this is right from the Federal Reserve's data. So this isn't, this is as clean of data as I can track on this, not politically influenced in either way. Takeaway here is the economy has been growing. Our real GDP has been increasing. The federal government has continued to spend more money than it takes in. But at the same time, I'll go back a couple of slides, but at the same time, tax revenue for the federal government has basically been on a steady increase every year, year over year over year, with a couple of years of exceptions in there. So our federal government has more money than ever to spend, and yet they're still spending more of it. At the same time, the economy has been growing. So long-term structural things that I do believe are going to have economic headwinds. And there's not an answer here yet outside of, we know that when you borrow money today, it gets paid for by the next generation. And so there's $38+ trillion of known government debt. It's over 40 trillion actually now when we get into this year, which they'll be reporting soon. When you account for unfunded liabilities with social programs like Medicare, Medicaid, Social Security, the number balloons. I've seen numbers in the $150 trillion of debt. It's a staggering number of epic proportion. Somebody's going to have to pay for that. And there's only a few ways that a government can get itself out of debt. It can grow the economy at a rate that's faster than it spends money. It could try and increase tax revenue by raising taxes, which does have a negative circular effect then on the businesses and the individuals. It takes more out of the private sector. Or they can inflate away their debt. Think Weimar Republic. They can print more money. I don't know which one over a long period of time our government's going to do, but if I look at current track record and how all political parties seem to have approached this, again, this isn't a bash on Democrats, it's not a bash on the current administration, it's just a look at reality. Math is math is math. Pretty much every president and every party that's been in power for as long as I can track has spent more money than they've collected in revenue, and they just continue to stack this debt. Somewhere, somehow it gets paid. What that likely means on a long-term basis, I have no idea what the timeline is for this, is that fixed income and treasuries would have to be devalued in some way, either through inflation or through a price mechanism. So on a really long term, we don't want to hold 30-year US treasuries. That makes sense? Happy to hold them in the short duration because they pay a yield that's roughly equal to inflation, which protects our clients' buying power. But we would not want to be holding 20, 30, 40-year debt notes of any kind. Quick one on household income versus inflation. This just underscores that basically the US consumer, while their actual income has gone up, their real income when adjusted for inflation is basically flat. Okay, a couple quick, I think I have two more slides, a couple more economic indicator points here. The median home price, sale of a home in the US, we've actually seen it coming down just a little bit since the early 2020s. So COVID, we saw for whatever reason, I think there's probably, it was all of the fiscal stimulus, all the government spending, things like that, drove home prices up. And then we've seen a steady decline, not a big one, but a slight decline in home prices. Now, this is market specific. There are some markets where homes still sell above asking price and they sell overnight. There's not a lot of supply out there right now relative to the amount of buyers, but the median home sale price has remained relatively strong, slight dip here going into 2025 and into 2026. 2 more slides on the market. This one is one we talk about a lot at LifeWorks here. This is the Shiller-CAPE ratio. So Robert Shiller is a Nobel Prize-winning economist. He started tracking a pricing or a way to think about the price to value of either an individual stock or the market. So CAPE stands for cyclically adjusted price to earnings. So price to earnings, or the PE ratio of the market, is essentially what's the price of the stock, let's say the S&P 500, what's the price that it's selling at versus the earnings that it's generating, the income that it's generating, right? So cyclically adjusted means it's adjusted for inflation and treasury rates. Takeaway here is that on this measure of stock market being undervalued or overvalued, the price to earnings has only ever been higher at one point in history, which is 1999. Actually, take that back. Nope, yeah, that's correct. Here's the lifetime one. Yeah, I was going to say, I think the 1930s had a high spike too. What this basically means is that stocks relative to the amount of earnings, the price differential has never been greater. I'm not saying that the market's due for a collapse. Again, we don't prognosticate, but this is important to know that a lot of the highest priced stocks and the stocks that over the last decade have had the best returns are ironically some that have had almost no earnings. So think technology companies like Amazon ran for a decade without, maybe it was more longer than that, without having any actual income. It was burning cash. Tesla's, the SpaceX's, although they're not publicly traded, but a lot of the high growth, high momentum tech stocks have very low net profit. And so their price to earnings ratio is really, really high. A high price to earnings ratio on a growth stock basically means you're expecting this company to continue this rapid growth rate and eventually get to where you have positive earnings. So there's always a cautionary tale in this, which means just don't go in, we don't go into long-term investing with our eyes shut. We recognize and we're thoughtful about how we're deploying our clients' capital and why we use factors, and we tilt towards things like companies that are more profitable, companies that have a better price to equity ratio. Probably one of the reasons why we've had some outperformance from the LifeWorks factor strategies year to date and even on a longer term run is because we're indexing to, meaning we're focusing on trying to find companies that have lower price to equity ratios, higher net profit, better potential financial stability. So this is one of my favorite ways of just kind of understanding the overall market value relative to the amount of income or earnings the companies underneath it have. And generally speaking, high growth tech companies are going to have virtually no income. So their price to earnings ratios are going to be generally really, really high. And old, boring, high income, or profitable companies, think like Coca-Cola, McDonald's, Walmart, things like this, generally have lower price to earnings because they don't have as high of an expected growth ratio to it or return. And they also are generating cash and paying dividends, et cetera. So this doesn't mean that we think the market's in for some kind of crash. This isn't a prediction of a bubble or something like that. But it is important to note that how we're deploying capital and how we're thinking about asset allocation for our clients is still very much long-term oriented investor, being thoughtful about not over allocating to companies whose stock prices right now are really high relative to their underlying earnings. All right, that is, you don't have to read the disclosures, the end of the presentation there. Happy to take questions. I appreciate everybody for following along. I thought it was going to be a little bit quicker than that, but as always, I had a lot of slides to get through. Matt, great question. Momentum is another factor that outperforms. Does LifeWorks incorporate that in its factor strategies? Yes, we do. The LifeWorks opportunity strategy is heavily weighted towards momentum. And momentum right now is typically picking up the AI tech stock trade that's been running now for a few years. But yes, we do. That's one of our core factor strategies is momentum. And the diversified premia, or our multi-factor, is the blend of the growth, momentum, tech factors, and then the value factors like profitability, dividend payout rate, lower price to earnings. And we blend those two together to try and generate a return that's similar to the S&P 500 with less volatility. That's the core thesis underlying that. Great question. All right, don't be shy. I do have a couple of things as we wrap up talking about what's coming in Q3 for our clients, for you guys in terms of planning, but would love to take some questions if anybody has them here for the next couple minutes before I close us out. Oh, Paul, you're asking me to put on my crystal ball. Let me take a shot at this. So I'll take Paul's question first. I'll just take Paul, Milan, Christian. I'll take these. When I'm doing the forecast for the business at LifeWorks, I'm going to just try and explain this in the context of my CEO lens, and then I'm going to extrapolate that to the economy and an investor to hopefully kind of maybe make a real world analogy. So LifeWorks is like $1.2 billion of assets and around 2,000 households that we serve all over America, all different walks of life, very wealthy families down to young couples starting out. But when I look at the forecast for LifeWorks and I'm asked to make capital allocation decisions and hiring decisions and technology decisions, and we're running a 5-year forecast, which puts us into 2030, what I try and do is I try and focus on the things that I know are going to be true, and I over-index to those things. So what that means is I know that we're coming into one of the biggest demographic shifts in the history of human civilization. So demographics are destiny. Birth rates are a leading indicator of that, right? So we've had declining birth rates. We have a large body of Americans, the baby boomers, that are retiring. And over the next 10 years, 15 years, we're going to see a significant number of them, unfortunately, or just it is what it is, pass away, and that wealth transfer. So what do I think about the 2030s? Well, I think it's really difficult to predict where technology is going to be, other than if I think about the cartoons I watched as a kid in the 80s and early 90s, the Jetsons being one, where there was flying cars and robot house cleaners and this kind of stuff. Inspector Gadget would be another funny one. I tell my kids about this. I used to watch a cartoon with a guy that had a watch with a little video thing on it, and he could talk to people. And now my kids roll around with Apple Watches and do calls with me, right? So it's hard, I think, to predict where technology is going to be, other than it's wildly going to surpass whatever we could imagine. That's my take. But things like the demographics, as the Gen Xers and the millennials replace the baby boomers from a retirement perspective, there's somewhere between 60 and $100 trillion of wealth that's going to transition from the baby boomer generation to the young Gen Xers and millennials. That's going to fundamentally shift real estate prices. A whole bunch of people are going to need to sell real estate because they're going into nursing homes, or they're retiring and downsizing, or they're dying. And most of the time, kids and grandkids don't want mom and dad or grandma and grandpa's house. I've talked about that. Whenever there's more sellers than buyers, prices will come down. We also have different spending preferences, right? So demographics is going to be a piece, and the consumers that are in my generation consume differently than the baby boomers, right? So I think we're going to see just a pretty big tectonic plate shift in how people engage with money, how we think about retirement, what it means. And then also we're going to have this absolutely massive tsunami of money And it's not like any one of us is going to feel it, but it's going to be slow. And then the speed is going to pick up, and then it's going to be like, bam, it's here. Where did that come from? Right. So it's going to be sudden, but slow building. From there, demographics is the only thing that I would really put my finger on. And then the technology side, man, you got the Elon Musk side of this where he envisions AI and robots making everything super inexpensive and everybody basically unlimited wealth. I think that's an interesting take. There's probably some reality that comes from that. And then you have the other end too, that thinks AI is going to drive us into like a Terminator-like state and create, some kind of extinction event for humans. So as far as what I see the economy doing, we're going to have the largest transfer of wealth in human history. And that's never been documented before, never happened at this scale. So it's going to create massive opportunities for people to build businesses, for people to serve the next generation. The next generation is going to step into a ton of money, which maybe they use to pay off debt and restructure their balance sheets. We'll see. Milan, your question about, do you apply the differing factors to different tranches? Yes, we do. So what we're doing with tranches, right? So our liability-driven investment methodology, which we've retermed life-driven investing because it's a little bit easier to understand. What we're doing is we're matching the right type of asset, so the right liquidity and volatility parameters and expected return with when we need to spend the money. So in tranche 2, if we're using equities, which we oftentimes are, sometimes we're doing hedging. We're likely to be doing more of that in the coming months. So expect your advisor to be talking to you about some of our hedging strategies that we use. But if we're holding equities there, we're likely trying to hold more value-based equities, things that have lower volatility, have some more certainty to them, have lower movements in price, and tend to pay a dividend, right? Things that might be more growth-oriented. An example, I know this isn't an equity, but we do have a small allocation to Bitcoin in most of our client strategies. And we look at that and say, that's a very long-term 10+ year outlook on investing in a new technology. Christian, you're asking the $1 quadrillion question. His question is this: a lot of analysis is based on historical information. How do you think of expected information? Very thoughtfully, I'm more interested in trying to understand the expected return on an equity versus the historical return. I've been a financial advisor now for 20 years. One of the greatest mistakes that our industry does across the board is they use historical returns to predict people's financial plans into the future, and they build model portfolios based on that. Demographics drives this. The baby boomers coming out of World War II, right? The silent generation, having the baby boomers, expanding home ownership, starting businesses, massive investment, right? That drove an economic boom cycle, the likes of which we haven't seen in modern history. And when you look at the returns in the stock market, all the smartest people that I follow have an outlook that assumes we're going to have lower returns on our equities going forward than we had in the past, because a lot of the return has already been priced in or baked in to the equation. And we're a consumption-driven economy. And so as our birth rate's declining, and as our government liabilities are going to be going up in terms of paying Social Security to all these baby boomers and retirees relative to workers, right? I think it's wise to be thoughtful about, we can't predict the future, but we can look at some math today that gives us a reasonable approximation for what expected returns would be on different types of assets. And across the board, expected returns on equities are lower going forward than what they were historically. So we do incorporate that into our planning and into our analysis. It's something where we'd rather be wrong and expect a lower return, right? And have it actually be a better outcome for our client. That's a good error. Then the other way around, which is to just blindly accept that the historical return in the stock market is going to be the same for the next 20 or 30 years and be wrong on that side and overstate the returns in our clients' financial plans and have their outcome be worse than projected. So we're probably more to the conservative end of the spectrum, looking at expected returns or expected information in a thoughtful way and basing our clients' planning off of that. So great question. Hopefully that answered that. Ooh, Milan. Okay, Milan's question. Playing off of Paul's question, do you see more tools like AI-based investing techniques applied? And you see a lot of this online now. Yeah, buckle up, folks, and get ready. The next generation of robo advisors is coming. And these are going to be online, no human in the loop, no financial advisor tools. They're going to claim and will use an LLM to research the market and build a portfolio. LifeWorks uses AI every day across the board. Research, my deck I built, we are probably one of the few firms that uses it a lot. Now, we're using it in very thoughtful ways. So we're not building portfolios for clients with it. We're not trying to take shortcuts with it. With any powerful new technology or tool, there's also another side of that coin, which is there's a negative to it. An example of a negative here is financial literacy in the United States has never been worse. And if somebody goes into Perplexity or Chat GPT or Claude or whatever the LLM is and starts doing financial planning or wanting to analyze the market, they have no way of actually knowing if the outputs that are coming back at them are even reasonable. Because less than 50% of Americans can answer basic financial questions. So I think there's going to be a real danger here, which is the idea that AI is this, access to the entire world of smarts and information at your keyboard. But if you don't know the right questions to ask, if you're not grounded in some base level of financial literacy, right, you're going to get there. People are going to be getting something back, and they're going to just, I think, be blindly investing based off of that. We do believe there's going to be thousands and thousands of online AI-based investing platforms. We're at the early stages of this. I think we're going to see a boatload of them coming. The SEC hasn't officially ruled on how this is going to work yet. So I think as soon as they do, the floodgates are going to open, and the Robin Hoods of the world, I'm not saying anything negative about them, but they were the early precursor, right? They were fintech in the early 2010s. They've laid the foundation now for direct-to-consumer AI-powered investing. And I don't think it's all going to be bad. You can see articles about some of the largest hedge funds and institutions like doing better research and doing it with less staff. I think that's probably going to be true. But the value of an individual who has context, financial literacy, and can communicate or connect the dots between what the client actually wants and needs and the data and the information, like we believe at LifeWorks, it's going to be more valuable than ever. The amount of noise that's going to be out there is going to increase thousands and thousands of fold. And it's likely going to be more important to have, I'm not just saying this is a pitch for LifeWorks, it's actually our mission and investment thesis. The value of a human advisor who's grounded in financial truths and economically literate is going to be one of the keys of helping people navigate the noise of AI that's coming. And if you've used AI at all, and I use it every day, I will still have even the best of Anthropic's Claude, current models. I'm not going to say make something up, but maybe misread data or misunderstand something and give me back something that's far, far, far from what is actual truth. Oh, I like this. So John just put a statement out there, which I think is great. A term we need to avoid, cognitive surrender. Don't give away your thinking to AI, but use AI to aid and sharpen your thinking. 100%. So again, for everybody that wants to know out there, we use AI for capturing notes with all of our meetings with clients, for helping us organize our emails and texts. We have an immense volume of data that's coming at us from clients and prospects and regulatory stuff, and keeping that all straight and helping navigate for you. Like, we use AI tools. Now, we're not using probably the same ones that you as a consumer are using. We're using enterprise versions of it. So your data, again, we're not actually pushing client data into, say, like Claude, but we are using it for notes and writing and research and things like that. And it's a force multiplier for people that think. So I love your statement there, John. All right, we're at the top of the hour. If anybody has to jump, from all of the advisors here at LifeWorks, I get to be lucky enough to be the face, and you guys get to watch me. I love my role as the CEO of LifeWorks Advisors, but from everybody at LifeWorks Advisors, we love serving you and your families. Our mission is to help you connect meaning and money and live intentionally. Our best self is helping you live rich instead of dying rich. And so we love that you're here. For everybody watching, thank you for being a client. Thank you for the trust you've placed in me and my team. We look forward to having you on another one of these live streams. And don't hesitate to send questions, comments, thoughts to your advisor and or directly to me. We'll do our best to answer them in a timely manner. So if you got to jump, thank you for being here. God bless. Have a great rest of your week. I'm going to stick around for another 5 or 10 minutes. If anybody has any other questions, happy to hang out for a few more minutes, answer a few more questions. Yeah, so Matt made a good point about some of the AI trading that's out there. You're absolutely welcome, Francis. Thanks for being here. All right, we'll leave it open for just another 60 seconds. If anybody else posts a question, otherwise I'll close our live stream out. All right, everybody, I didn't see any more questions come through. Again, from all of us here at LifeWorks, we love serving you and your families. We wish you a great rest of your week, and we look forward to seeing one of our live streams again or connecting with you soon in one of your planning sessions. Take care, everyone.